Here we are, folks. Another Tuesday evening. Welcome, welcome. Great to see you on this evening. Thank you very much for taking some of your Tuesday evening to join us. I've got Damien teed up ready to come in just a moment. Have a very interesting conversation, of course, with everything that's been going on in recent times. Of course, the markets had a bit of hiccup over the last month and then, well, back to where they were. So how much has changed? How much is the same? We'll be able to explore that and obviously take questions and things as we go through. Just before I do that, a bit of perspective on the dogs. We've only got 2 dogs now. I was dog sitting last week, as you may recall, but we're back to 2 dogs this week, and they've had their lunch, they've had their walk, so they're now happy just to lie and enjoy the conversation. Meantime, here's a picture of the studio, and of course, we've got Damien there teed up ready to come in. And we've got everything set up as normal with the multi-view, with the chat, with the control systems, and a few other things going on there as well. And I think everything's working, hopefully. We have the normal few technical hitches as we fire everything up, but everything is working now. And we'll be good to go in just a few seconds. And see that Jump for Joy has just jumped in there. Hello, welcome, welcome, welcome. Good to see you on as well. Hope you're all well. And welcome to all the others who joined a little earlier. Right, I think we're ready to go now. So I'm going to take the pre-show off. I'm going to run the start of show, and I'll be back in just a moment. Well, good evening and welcome to this live stream on the 3rd of September 2024. Can't believe it. We're into the northern autumn already. What happened to summer? And of course, it's Martin North here from Digital Finance Analytics. Great to have you on the show this evening. And thanks very much for taking some of your time out of this Tuesday evening to share it with Dan and myself. Just before I bring him in, let me just remind you, as I always do, that we don't provide specific financial or legal advice. This is a general conversation only. We do moderate the chat, but encourage you to put your questions and comments in. And specifically, if you've got something you'd like to get to the top of the queue, you can use that Walk the World to get to my attention, and you can use Super Chat to get it right up there at the top of the queue. And of course, more broadly, if you'd like to support what we do, Super Chat's the way to do that. Really appreciate those who do use that mechanism. It just helps to cover some of the costs. We don't do this for profit. We do this because we think there's a really important conversation to be had at the moment. Without further ado, let me bring Damien straight in. Hi, Damien. How are you going?
Not too bad, Martin. Good to see you again.
Can you believe it's only a month? But boy, a lot of water has gone under the bridge. Of course, we had that... the market's heart attack for just a little while. Here's the ASX 200.
Yes.
You can see that big drop, and then we're back up to pretty much where we were, which is pretty much where most of the markets have been and gone. So I suppose the sort of the top line question is, what happened? I think we're discussing just after the drop, and we said, don't panic. This is abnormal. We'll probably settle down, and it sort of settled back to where we were. But I wonder how much has really changed and how much is the same.
Yeah. Look, I don't think the fundamentals really changed too much throughout that time period. I guess there's a question about, and we'll move on to sort of this idea about there being this real flood of capital out there in the markets. But I guess it's the best explanation, I think, for a lot of these things comes for me from Victor Schvetz, who's got from Macquarie. He's got this basically a model that he runs in terms of talking about this excess of of capital sort of floating around the markets, and the idea that, well, this capital's out there, it's bidding up market prices, whether it's property or housing, property or stock markets or bonds or whatever it is. It's sort of moving back and forth from asset to asset, and the thing we're looking at the moment is you get these moments of sort of indigestion where all of a sudden the capital starts flipping between one or the other, and this idea that, look, there was a couple of bad bits of data, so maybe there was a bit of that coming out, but then the whole Japanese carry trade and questions around that, and so is this just a matter of we get these moments of indigestion, but we've got these central banks with fire hoses rushing around, ready to put out the slightest bit of smoke that they see. And and I guess if that's the thought process behind, and I think that's quite a reasonable outlook, sort of from or quite a reasonable model from my perspective, is that you're basically using any of these moments of market indigestion and trading issues to basically get yourself set again for the next leg up. And so and I guess there is implicit in that, there's this idea that it's a little bit of a Minsky type thought behind it, in that, look, because we've got central banks rushing out there keep trying to make things better and keep trying to throw more money at problems, stability breeds instability. So you basically need to get so bad that the old tools don't work, and then you have some sort of crash that actually ends up that is actually enough to force markets markets to sort of reevaluate the multiples. And if that's the case, then that's what we're looking for, is big enough events, and the small events along the way are sort of central banks are just stepping in and flooding us. So we saw it with what do we see? Just in the last couple of years, Bank of England. Sort of we had something similar there for when the whole Liz Truss moment that occurred. We've seen this one. There's one or two other ones I had in the back of my mind. There's a quant quake we had a few years ago. Like, it's these types of ones where the capital's flooding around. That's the banks in the US last year. The crypto. Probably 18 months ago now, where all the crypto stuff,
FTX and what have you, yeah.
And then we've got the Fed and everyone turning around and go, yes, we'll save you. Well, bail out. There's more money coming, and and they are getting faster in terms of the central bank reactions as well. And so the question is, do we need to wait for something really big to actually put the market off?
If you think that's a crisis, wait for a crisis, I think is probably what I'd say. And there is a certain nervousness around, it seems to me, Damien, that a lot of people are saying, well, if you look at ultimate valuations, they are extended. It's true in the US, it's true in Australia. And in fact, if you compare Australian shares with the US shares, I think they're probably more extended than they've been for a long, long time in terms of their relative valuations.
Well, I've got a chart up there I can pop up if you want. Now, particularly on the banks. So there's 4 different ones, and apologies if these are a bit small, but in clockwise order from top left, we've got the Australia versus the world, where we're trading almost at parity in terms of the Aussie markets, 0.97% of the world. And this is just looking at forward price to earnings ratio, which is it's really just one of a whole scheme of different things we use, but it's probably the most common one that people would look at. And so it's basically going, well, the average is that the Australian market trades at sort of 0.95 to the world, or 0.94 over the sort of longer term, and we're at 0.97. So it's there or thereabouts when you look at it from that perspective. The reason why Australia is generally a bit cheaper is because we're chock-a-block full of banks and resources, and that's they tend to be much lower multiple. And so it's actually, I find it quite instructive to actually separate out and look at the three separately. So the top right then is looking at Australia ex banks and resources. And it's sort of similar in that we trade sort of about 1.05 on that one, and we're at 1.1. So a little bit expensive relative to the market, relative to the world, but certainly nothing too extreme. The bottom left is a really interesting one. So the Aussie banks, which typically trade about 1.2 times, are trading at 1.85 times the world market. So it's sort of 50% above the usual multiples that they trade at. It's up there, and almost all that's CVA. It's very much driven by that. Now, there is an argument that the Aussie banks are much more protected than some of their overseas brethren, and that they've got, I guess that the Aussie banks have got are being allowed to earn higher rates of return. Whether that's through lack of regulatory oversight, or from I guess friendliness with regulators and other factors, and there's possibly that's true. Having said that, though, there's just a question about how much more. And is it 50% more? Should we be pricing Commonwealth Bank like we price Google or somebody that's part of the AI boom and look at growth? It seems weird to me, but yeah, but certainly it seemed weird for a few years. The pricing on the Aussie banks, and so it is hard to reconcile.
Well, even John Mott, who of course is one of the prime bank analysts, made the point recently. He doesn't understand the valuations of the Aussie banks, and if you compare it with J.P. Morgan, for example, in the US, we're way over. But the truth is that this is the CBA share price, right? It's now up at 143. It's taken over BHP by quite a mile now in terms of total market, size, as it were, in the Australian market. And if you actually peel back the onion and look at a little bit more detail at the margins that the banks are actually making, they're actually under some pressure. CBA less so a little bit, but it's showing. And I suppose it comes back to two things, as you say, the ability to which the banks in Australia, the major ones in particular, are basically understood to be underwritten by the country. They'll never fail because the country will always bail them out. And, well, that's probably not a bad bet on past history. The second is that the margins.
There's a question about whether they're failing versus making a profit on buying your shares. But yes,
yeah. Good point.
Not necessarily the same thing.
And then, of course, the margins, the net margins, tend to be higher. That means that consumers in Australia are paying more for their banking services relative to other countries. And I'm quite surprised, in the UK, looking at the bank charges and looking at the margins, they're quite a lot lower than they are in Australia. So that protected species of the banks means that people are paying quite a lot more. And then the third is, in terms of the relative exposure, to an extent, of course, Australia is seen as a little bit of a proxy into China and some other areas too. So there is actually some interest in investing in Australia, not just for what's going on in Australia, but for Australia's position vis-a-vis the Asian markets.
That's right. And so, I mean, if you were an international hedge fund and you wanted to buy, you thought that you wanted to get exposure to China, but you didn't want to. You're worried about direct, buying of Chinese shares for a whole bunch of different reasons in terms of that market. Then Australia's a pretty good proxy. And if you're buying Australia, then you're probably buying. A lot of them are how can I put it? They're relatively indiscriminate in terms of they'll just be saying, well, look, I'll just buy the ASX 20 or I'll just buy the MSCI Australia or whatever it is that they want to buy. And that just means they're bidding up the price of these stocks, certainly the bigger ones, without sort of reference to the prices. But the other one that was going to pop up on that is, so I mean, in terms of China, there's a whole, we'll probably get to that, I suppose a little bit later, but there is this idea that's certainly popping around in terms of saying, well, if the business in China has changed, and we've spoken about it a number of times in this, I'm sure we'll speak about it later in terms of, they were really driving that whole property market for 20 odd years, and the demand for commodities and all that type of stuff that was coming out of it. And you've had David who worked closely on here, who writes under the moniker often of houses and holes, because it's the idea is that Australia has a bunch of holes in the ground. We dig up dirt, we sell that dirt to overseas, mainly China, and then we use that money to go and bid up the price of our houses and sell them back to each other. And so that's where you get the Commonwealth Bank and BHP as your biggest companies. Now, if China is genuinely undergoing a change in the way they're operating, and they're going to stop pouring as much capital into houses, and they're going to spread that out into different areas of the economy, and most likely some of the high tech areas seems to be where it's going at the moment, is that there's going to be different winners and losers. And I think there's still this bet, which has been a great bet for the last 20 years, which is whenever China slows down, they're going to throw more money at the housing sector, so buy Australia. And you certainly see that every time we get a new announcement pops out for what China's going to do to help the housing market. And usually you get a bit of a pop in some of these resources prices and for a couple of days, and then eventually the market sort of, the wisdom drops out there and they're going, no, they're not doing anything different yet. They haven't flipped around to stimulate. And if they don't, then the winners for the next 20 years aren't going to be the same as the winners for the last 20 years. If they do, if they do flip around and go back to the old model, then yes, you're right to be buying resources at the moment. But I do think there's we're at the end of a 20-year run where the answer every single time was, rely on China to bail out the property sector. And I don't think that's true anymore. And if it's not true, you need different companies.
Well, certainly they do seem to be wanting to support consumer consumption inside China this time around, right? In theory.
Well, yeah, sort of. They say they are. They say they want to. They just don't want to give it any money. Yeah. Like they've got all these announcements out there, and particularly this latest one. I was reading some. There's different people you read, and some of them are bulls, and some of them are bears, and some of them will talk up the talking points. But even the most the most supportive, I guess, of Chinese government policies was sort of talking around. We've got all these great plans to increase the consumption as part of the economy. There's just nothing. There's no money being put towards it. It's all just like it's exhortation from governments to, Martin, you're a Chinese consumer. Can you please go out and spend more money? And would you like some cheaper debt in order so that you can do it? It's saying, well, that's not really, And then China's already got a lot of debt for a country of its development stage. So, if you look at it, how much debt does the Chinese consumer have relative to, say, the American consumers? Yeah, it's still miles below. But if you look at how much does the average Chinese consumer have versus countries with a similar income profile, then all of a sudden they look like they're right up there in terms of the amount of debt that they've already taken on. So there are. I think there's limits. I think they've reached their limits on the housing market, and they're not as far away as I think some would think on the consumption side. So
it'll be very
slowing China is very much fair.
Very interesting to watch. And of course, one of the factors in there is the iron ore price and what's going on with iron ore, and that's quite a fascinating story, right? Because we've basically seen, iron ore price is getting a little weaker. The demand is looking a little lower. Although I noticed that China is still exporting a lot of finished iron ore out. So what's going on?
Yeah, well, that's an interesting part. Now, I think that's the one more clue about what's going on. I might be wrong on this one, but it's very much makes sense to me that you've built all these steel mills, and they're all designed to import iron ore and turn it into steel and get that out to the Chinese housing market and infrastructure market. That's what's been happening. The housing and infrastructure market isn't building anymore, and it's slowing down, and so they haven't got the demand, and so these guys are still producing it. And they're like, oh, what else are we going to do with it? Okay, we're going to try and get it out onto to world markets. So even though we have seen significant falls in the amount of steel production that's going on, it's still above the falls that have actually happened in actual steel use in the Chinese economy. So this is not a positive sign that Chinese companies are out there exporting to the rest of the world. That's a sign that, hey, we're just producing this stuff because I built this steel mill and it can do whatever, 100 units a month, and I don't want to run it at 50 units a month because then I'm losing money. And so if I can run it, but there is only demand for 50 units, so I'll try and run it at 100 and take that other 50 and export it if I can. And so I think that's where, we're gradually reaching a recognition of that. Now, so what do I think in terms of where does the iron ore price settle? I suppose is probably the big question. And the answer is, well, if we're producing too much of it, and we've got these big mines coming on from Africa in next year and a half or so, then the prices need to be low enough to start shaking out some of the producers. Now, there are a bunch of producers who produce around sort of, 80 to 100 or plus, but they tend to be not the big ones. And a lot of these are the ones where, they set up the mines and some of them literally just truck the iron ore in and out because they're like, well, I don't want to go to the hassle of building a a rail line or bigger facilities, because I know that when the iron ore price gets to $80, I can't. I'm going to go broke. And if I've bought a rail line, maybe that lets me get to 75, but it really doesn't help in the bigger scheme of things because of the amount of money I have to spend on it. So there's a lot of small players which will drop out relatively quickly. But in terms of actually making any reasonable headway, you're going to have to get into the 60s at least in terms of the iron ore price. So considerably further down from where we are. And if China keeps going the way it's going, then you're going to have to start knocking out some of the big guys, some of BHP, Rio, Vale, South African one, Kumba. Yeah, you need to start knocking out some of those mines that are really those big production ones. And I don't know, you probably need to go into the 40s to start knocking some of those out, because a lot of this is about, and this is true with all commodities, is you spend a lot of money up front to build a mine. And so even if you're running it at a loss, you might keep running it at a loss for a little while because of the view that actually if I shut this thing down, then getting it all started back up is actually very difficult. And so, and your marginal cost is the marginal cost is really what you care about. And what do I mean by that? So I spent $100 to build myself a mine in my backyard, and then it's costing me, and then this is going to run for 10 years. So effectively, it's like I've spent $10 a year, and then it's going to cost me another $5 to run it every year. So if I'm making $15 from it, I'm breaking even on the whole project. But once I've built the mine, now that $100 is gone. I'm only spending $5 a year. So the price can go right down to $5 before and I'm still making a bit of cash flow out of it. It's better than making nothing. So I still want to keep running my mine. So you need to get below that sort of marginal cost. And that's a long way down. If China keeps going the way it's going, there's we don't see any other sort of sources of demand for iron ore popping up. And that would be my expectation. But yeah, we'll have to see where it goes. So we've been short on ore stocks for a while, and certainly riding that theme throughout the next couple of years, I think.
Yeah, and just on that, this is the iron ore fines of 62%. It's the US one I just picked up quickly. You can see that we had 220 was the peak back in 2022, right? And we're around the 100 or a bit below. And there were different iron ore prices for different types of iron ore, but it just shows you the trajectory and the swing. It's worth highlighting that back in 2016 on this chart, it was at 40. So big swings.
And that was a big property market slowdown in China. And so, and actually, I mean, it looks pretty similar to where we are now. The other factor that's going on is they haven't been doing anywhere near as much recycling as what you'd expect. And we think some of that it's hard to tell why, but there's sort of basically two ways you can produce iron ore. One is sort of from scrap, and it usually costs a lot less, but it's very energy intensive. Or you can go from the raw iron ore and sort of push it through the whole cycle, and so energy costs as a proportion of your total aren't as much. And so we think there's that iron ore price has sort of been held up artificially insofar as China's been happy to, or has made the trade-off of saying they'd like to have lower electricity prices while the whole Ukraine war and Russia, sort of pushed up energy prices. That they've made, effectively made a decision to we'll have higher iron ore prices, but we'll have lower energy prices because we're not recycling as much. But at some point that will change, and at that point it's we think there's some artificially high iron ore even within the price we're looking at.
And of course there are consequences. So this was the current account balance that came out today, and it shows basically that the current account is going the wrong way, and basically it means that the exports were down. The other interesting factor in all of that, I noticed also, Damien, was the fact that the growth, a lot of the growth is actually in the Australian context by government. So governments are investing quite big on all sorts of things, state and federal. We're seeing employment more and more in the public sector than the private sector. But the traditional growth engine of very strong resource exports looks to be coming under question.
Yeah, and I'm going to take a slight detour. I will get back to that government though as a
Mhm.
percentage because it was actually something I was going to mention a little bit earlier about the makeup of stock markets and CBA in particular. So I haven't gone. I will come back to that, but there's this idea that if you're running an economy, there's some businesses that are out there trying to create new products or improve on products and provide that to people as a service or as a good that people want to buy. And the idea is try to be innovative and help supply what people want. And then there's the idea as well. There's other companies out there that are there as you don't call them parasites, but they're there to take money off those. So you say, okay, if I'm renting a building if I'm running an AI company and I'm renting a building, well, this building was built probably it might have been 20 years earlier, and somebody owns that. They put the money in. They're not actually really doing anything productive with it. They've just built the building and they're trying to keep it up, and they're charging the companies that are out there trying to do something, trying to create new products. So I'm not saying they're terrible companies and whatever, but they're not companies that are out there adding to your productive capacity. And banks sort of fall into that same category in terms of saying, well, okay, you're better off having an Nvidia or Google or Facebook or someone who's out there trying to create these new products that people want, or you're better off being the banker to the person who's lending to them and having fees. You're like, well, I'd prefer the banks make less of a profit and the companies out there. Um, I'd prefer to have an economy with more of these companies that are out there trying to do innovative things. So then anyway, the long story with the Australian economy is if you look at the Australian stock market, and let's say I'm going to add resources in because I can't remember what the difference is. Well, resources is such a tiny measure of overseas stock markets. Is you get sort of 2/3 of the Australian stock market is either in banks, utilities, REITs, all these companies that are basically just we either own assets and just renting it out or we're providing the services. Whereas most other economies, it's sort of 20% or less.
Mm.
And so we've just got this massive exposure to these. So that's one side. And to complete the story, when you get back to the government stuff, is as you well know, Martin, a lot of these government ratios, when you look at it, without saying, well, what is how do we judge what governments are adding to GDP? It's just basically, well, how much do they spend? And so there's a bit of that circular reference. If you went and put up all your public servants' wages or whatever it is, and you might be, they're not out there trying to create. You're usually not out there trying to create productive things. They're out there, maybe. And I'm not saying regulation is bad. We do want regulation, and we do want all these factors to go in it, and we want people to build things that stand the test of time and things like that. But they're not adding to the productive capacity. And so, if you're increasing government services and government spending on that government side, you're probably not adding to the productive capacity overall of your economy. And so you're sort of just measuring your own inputs. You're measuring what I'm putting in is what I'm measuring as growth. Yeah.
Well, of course, GDP is a flawed measure, as we've discussed many times before. It's just activity, right? And it can be all activity, whether it's gun running or selling drugs or whatever, right? It's activity.
Yeah, that's right. And some of that will float in the non-official part, but yeah, but it's the Keynes one is broken windows, isn't it? Mm. It's productive to break windows and then fix them.
But my sort of theory of the economy is what you're trying to do is to create more value. So rather than just moving the same dollar around the system, what you want to try and do is to use that dollar to create more value, which you can then actually really grow the economy. But actually just effectively passing the parcel and using the same dollar around the system, which is what a lot of it is, doesn't actually help. And so if you think about the growth and employment in aged care and those things, they're really important services. I'm not saying that. But in terms of actually growing the economic momentum and growing the future, it doesn't necessarily directly help. It's a lovely thing to be able to do, but unless we've got a significant proportion of the economy actually creating new stuff and creating new value, it's hard to pay for that other stuff too. And that's the bind that we seem to have got ourselves caught in, where effectively more and more of the activity is, supporting the existing mode of operation, as it were, but it's not creating new stuff, new value.
No, and yeah, we can't emphasize enough. These are all important things to do, but we don't want to measure it and say, hey, look how great our economy is going because we've decided to pay all our aged care workers more money. And saying it's a good thing that we are paying them more money, but that's not a sign that the economy is working really well. Yeah, we need to make sure that we've got all these others. So absolutely.
And so, if you sort of think about the Australian economy, I think there are some big questions. We'll get the official GDP tomorrow, and most people are thinking it's going to be relatively low. But we've got another problem in Australia insofar that the inflation story is still relatively aggressive relative to other countries. And, it's interesting now the Fed has pretty much, I think, started to signal that they're going to cut rates in September. That was one of the earlier sort of hiccups that we had with regards to the stock markets that we discussed earlier on. But in Australia, it does look as though, because of the fact that inflation is a little bit more stuck, as it were, at a higher level, that in fact they won't be able to cut rates. And in fact, there was an article that came out the other day. This is actually Hauser, the Brit, who's now the number 2 of the Reserve Bank, upset a few people when he talked about false profits. But he made the point that the Reserve Bank of Australia won't be able to follow the US Federal Reserve and cut interest rates because inflation is still too high. And 4.35% is not very high by global standards. And I think that's an important point. So we've got ourselves stuck now with inflation sort of hanging around, with interest rates not as high as in other countries, but therefore not as bearing down on inflation as other countries. An economy that's sort of going sideways or worse, a lot of government support trying to compress inflation, but the RBA is saying, well, we're going to look through that because that's merely just, temporary. And then, of course, you've got this squabble between the RBA and the Chalmers particular saying the RBA is smashing the nation, isn't it? Rates are
it's not my fault.
No, it's not exactly. So we got this big political stoush going on at the moment, and in the meantime, people are getting caught in the crossfire.
And I'm siding with I think it is the government's fault, to be honest. I think there's I'd extend your description of the economy to going one level deeper and saying, well, actually, what we're looking at is GDP per capita and income per capita and all these different measures on a per capita basis going backwards, and it's been going backwards for. I don't know if it's a record time, but it's certainly an abnormally long period of time that we've been going backwards. But we're flooding the country with so many immigrants that our overall GDP is going up, and so that's the position we're in. And I think that's very much adding to all these factors. So because we've got all these extra people, we need to spend all this extra money, as you said, on new train lines, new roadways, all these things like that need to come in, and schools and hospitals and the reality is, when you're doing most of that is all infill, so we're doing it on existing cities, and so it costs way more money because it's just that more expensive if you have to buy all these existing houses to build your new motorway. Then we've stepped up the energy side, and so we're basically we're enforcing on East Coast Australian companies anyway, at least energy prices that are the same as the rest of the world or higher. We're basically letting the energy cartel charge whatever they want. We're talking about importing gas while we're simultaneously one of the world's largest exporters. It's just Anyway, we could spend a whole topic on that, and I'm sure we have in the past.
Cover that quite often on the show here. But it's important context, right? So what we are actually saying, Damien, is that we are in the situation we're in because of a whole series of policy decisions that have been taken over the past 20 years plus, right? Those policy decisions are now coming home to roost. And the question is, are we going to be able to actually find a way out of this, or are they going to have to change the story? Right? No,
that's right. And then you go, and that sort of flows through. That energy, is this insidious into everything, whether it's, your cost of chemicals and the cost of building materials, and there's all these factors that goes into and just the just general rent of it. And it's such a small. It is a relatively small part of the whole economy, but there's certain things it just adds to, and these are preventable errors, and so I think you've got a government in a way, to me, that's effectively saying, what's the RBA doing keeping interest rates so high, trying to keep down this inflation that we're causing by bringing in so many people and not having a proper energy policy? And so saying, well, they're doing what they're meant to be doing. They're trying to, yes, it's not a perfect solution. Arguably it's a terrible solution to do. You'd be much better off running proper government policy and not having this problem. And so, so I think there's been mistakes clearly made. I think you're right insofar as saying this is not the first government to make similar mistakes. I think our last government was making very, very similar mistakes and is talking about making similar, even potentially. Well, they're talking about making different mistakes as well. The libs in terms of the mistakes they'd like to make with it the same. But the net effect is we're making those mistakes right now with this government, and I think it's very hard for them to turn around and complain about this. And that's one of my, I think there's. I've spoken certainly to a number of other people about this. I've probably spoken to you about it, is saying that there's a certain argument behind having independent central banks, and the whole idea is that we have this independent central bank. They're the ones who can actually pull the policy levers and keep inflation, because otherwise, when you let politicians do it, they'll run inflation too hot near elections, and then and we'll be in this much bigger cycles. There's a reasonable argument around that. The flip side is you run into exactly the cases we're talking about now, and we've seen it several times over the last decade, where we've got governments and the central bank working at cross purposes. Yep. We had Morrison, and Abbott and the whole, every other Liberal politician we had over there trying to hit surpluses. Meanwhile, the RBA is trying to press on we need some inflation. We need you to get out and deficit spend and get the economy going. And so they're sort of pressing on that. And then they've flipped it around, and now we've got the opposite, where we've got the government, bringing as many people as it can, running these things and effectively, helping to cause inflation, while we've got a central bank who's trying to pull back on it at the same time. And so, I do think there's quite a large part there. The other thing just to keep in mind as a big overlay, though, over this whole factor, is there is a question about how much central banks have really done in this whole cycle, and are they congratulating themselves far more than what they actually deserve, in terms of it being, it was largely a cycle around lack of supply, and that's not something where interest rates really fix. And so we had this supply chain bust and whole lack of supply, and inflation shot up. And now it's come flying back down the other side, and central banks raised rates, and now they're dropping rates. But there's sort of this interesting question about, well, if central banks weren't there and they hadn't done anything, we probably would have had a very similar shape. Yes, it might have risen a little bit higher, but it might have ended up falling further by now. Like, there's a sort of a question around, and I think that's where. We're certainly thinking about these and how we're shaping our view on things like currencies and things like that, about saying we want to make what's based on all of these inflation ideas and where our interest rate's going to be. But there's also an overlying factor of, okay, let's not pretend that central banks certainly didn't cause all that inflation to come through, and they probably didn't solve as much as they'd like to complain. They'd like to say that they did. Yeah.
Well, it's interesting because the Fed Fed Chair Jerome Powell at Jackson Hole tried to explain where inflation came from. I don't know whether you saw his speech there, but he was basically sheeting it all to the costs of goods, post-COVID, et cetera, and through COVID. Actually, the truth is that the amount of money that was thrown into the system, thanks to the quantitative easing, ultra-low interest rates, all the government support, the money supply actually was the cause of the inflationary sort of flow that we had. And it's interesting that if you actually look at it another way, this is actually the quantitative tightening cycle now that we're in. So, the Bank of Japan, the Fed, ECB, and others, they're all doing quantitative tightening. So they're actually buying stuff back. But in parallel, governments are still issuing more and more debt, to the point that the global debt has reached another new high. It's what, $300 115 trillion, according to the most recent figure, and it's still very high and going up. And so the servicing of that debt, this is actually a US story here, but it is quite interesting. The US Treasury payments have gone way through the roof. And so more and more of governments' ability to pay is having to go to service that debt, which is still growing. So you've got to ask the question of, not only are central banks and governments pulling different directions, but they're actually also, in a way, smoking the same opium, right? Because you can see the problem building.
Yeah, that's right. And I do think there's a reasonable amount of this is inequality. And I think that the comparison between China and the rest of the world helps to illustrate that point, insofar as I give $1,000 extra to Gina Reinhardt, and what's she going to do with it? She's not going to rush out. She doesn't need extra money. She just throws it on the pile and saves it. You give $1,000 to a homeless person in the street, and they're rushing out and buying stuff. It's gone quickly. And so the idea is around that. What we did was we went through this process where during the pandemic we gave out all this money and we actually helped inequality by taking this money savings and passing it out. And that helped cause that inflation, which is, why couldn't we cause inflation for years? Well, we were letting inequality go the other way. Now we've flipped it back around. And the irony of the higher rates is effectively that's what we're doing in a way, is we're basically saying to governments, well, if you're going to keep spending all this money and spreading it out, then we'll make you pay more for it. And those interest rates tend to end up going to rich people. The poorer people don't have the savings to take advantage of those, and so the rich people are then going to save more. And but that's yes. Anyway, that's something we're not going to solve. But I think in terms of investing, we need to think about that because it is a major factor.
Well, it's a very important factor. Thinking about longer term yields. Right? Yes. Because if in fact the truth is that we're going to see governments continuing to drive the debt burden higher, there's going to be a requirement for a risk premium, it seems to me, into the medium term. And that is potentially going to keep rates higher, particularly in the bond markets. And of course, and I know that the relationship between what's happening in the bond market and stock markets are actually, well, they're certainly connected, aren't they?
Yes, that's right. And what we've had a couple of people recently come back to us, just looking to lock in longer term rates for a long time, and it makes a lot of sense. So if you are an investor who is happy with a 4.5% return on money because you want to leave it in cash or what have you, then sticking the money in the bank right now and possibly getting a higher return than that, but with the risk that goes down in the medium term, we could end up back where we were in the throughout the 20 teens. Yeah. And so there's a number of people we've got who are basically just locking into some long-term bonds. You can get take a 30-year bond if you want. I think there's a 2054 bond, which you can get yourself a yield that's 4% or more. So and lock it in for the next 30 years. Yes, there's got a lot of capital bouncing around, but if you just wanted the income anyway, then you're not going to sell it. Then it doesn't really matter whether the capital goes up or down. It's a bit like your house. If you're going to live in your house, then what does it matter if it's up 20,000 this week and down 20,000 next week if you're not going to sell it? So I think there's sort of been looking at that for a number of income investors. And
it's interesting because there is a lot of money sitting in relatively short-term money market funds at the moment looking for a home. And that's true in Australia. It's true in the US too. So if you think that stock markets are relatively now peaky at best, you probably wouldn't want to pile more into them at the moment, particularly when September and October tends to be a rather tricky time to think about where markets are going. So maybe it does make more sense to go for some of those other options. And as you say, you've got skills. So that's worth highlighting, isn't it? People invest for different reasons. Some people want more certainty. Some people want more growth and more opportunity. So that means it's not the right answer for everybody. But it is interesting that there's quite a lot of short-term money still sitting on the sidelines saying, I'm not sure what to do. Yeah. And I do think there's
I guess maybe I could word that a little bit better. Is that if your strategy is to have a certain amount of money in cash or cash equivalents and earning a return because you want to get you want to collect the interest on that, and you like the fact that you can get 4 or 5% at the moment, and you want to maintain that, then leaving your money in the bank runs the risk that we head back to something very similar as to what we do in terms of falling interest rates, and you might be getting 1 or 2% on your money instead. And so, whereas you can lock in, the rates might be a little bit lower than what you might be getting directly on the banks now. But as I said, 4.5%, and locking in for sort of 10, 20 years, you can be a pretty, for some people, that's taking a part of their money and locking that away is worth it. The thing on the flip side, on the stock market side, though, is that the real question for that is earnings. And I've got a chart up I just wanted to show you that sort of illustrates my point. So what I've got here is this is just a US S&P 500, and the blue lines on the chart are showing what did each year do in terms of forecasts. So in 2022, that blue line was sort of up at 200. The first blue line was up at 250. That was what people were expecting for 2023. And then it sort of fell, 20, maybe not, almost 20% over that time frame as it came down to where it ended up at sort of 220. And then we sort of saw something sort of similar for 2024, but it certainly it fell during 2022, but it's flattened out and really hasn't moved. And then we've got our forecast for 2025, which is sort of gently going upwards, and 2026, which are up again over that. But the key part is not losing. You can lose track of some of those blue lines and worry about downgrades and upgrades. The real key is this red line. That's like your weighted average over time. So it's basically, that's like looking forward that 12 months that we're talking about, saying what's going to happen from now. And because each line is progressively higher, even if you do get some downgrades, say to 2025, earnings come down another 10%, that red line's still risen overall. And that's the key now, is saying, okay, why would you want to buy into these expensive stock markets? And the question is saying, well, we're actually seeing some pretty reasonable earnings growth coming through. And if you're getting a reasonable earnings growth and a decent dividend yield, and there's still a potential we might be going to some sort of AI sort of boom where prices get even crazier, then there's a reason to be invested in stock markets, because there are certainly times where stock markets look expensive, but if you get another 5 or 10% earnings growth you weren't expecting, all of a sudden they come back to looking much more fair value than you sort of. It's two parts. There's stock markets can get better because they can become cheaper because the stock price falls, but they can also become cheaper because the earnings rise beneath it. And at the moment, we've actually seen some pretty strong earnings growth.
Well, let me just counter that by saying the Federal Reserve is now talking about cutting rates. September probably, and the markets are saying another 2 or 3 this year and more next year. But this is an interesting chart just to make the point that every time pretty much the Fed starts to pivot, markets then actually drop. The average is about 21%, I think, or maybe 25, depending how you calculate it. But this chart just makes the point. We could be in for a little bit of a
bumpy road along the way.
And the argument is, one, it's because, of course, the economy is less strong, and therefore they're trying to actually be a little more supportive rather than actually restrictive. But the other is, as those situations develop and as the economy weakens, it means that profitability from corporations goes down, and therefore the earnings multiples actually need to adjust accordingly, and that's why prices come down. So I'm not saying it's going to happen, but I think it's quite an interesting observation that we do seem to be potentially at a bit of a turning point with regards to interest rates, what the Fed is going to do, and the consequences for the market.
Yeah, absolutely. And particularly if you look back at those, say the 2000, one in the early 2000s and the one in the around the financial crisis, those big drops, earnings fell by that type of level, like sort of 50-ish%.
Yeah.
Maybe the first one, it wasn't. No, it's probably only 30-odd% that first one. But easily sort of some really big changes in terms of the earnings expectations for companies over that time period. So then it's a question about, and I think that the 35% one, it's a tough one. That's a pandemic. So we certainly had some earnings falls in that period, and we certainly had prices fall, but it wasn't a normal cycle. And so this is the question now: are we going to go through a normal cycle or not? Or are we still in some sort of weird cycle where, we've got this sort of push pull between, we actually had our weak company earnings, 2 years ago as all those earnings fell off, and now the earnings have actually been ticking through, not too bad. Or are we about to go into sort of some sudden downturn? Now, there's the cases for and against. So what am I looking at that I'm worried about on that front? Q3 earnings. So Q2 earnings came through really strong, way better than they have for years. What's been happening for the last few years is that companies have been saying, or analysts have been forecasting, they're going to earn 5 to 10%, say, in 6 months' time for that quarter. By the time they get to that quarter, it's -5. This quarter was the first time it's actually been in that 5 to 10% range. Was Q2. Now Q3 earnings are coming off, but 2025 and Q4 numbers are really high and sort of 10% plus growth. I feel like 2025 is looking for 12 or 15% growth. Like, it's depending on how you want to cut the numbers and which sectors you want to include. It's just, there's some is the Q3 stuff, is that a little bit of a blip, or are we genuinely going in? Is this a start of the whole slowdown? And are we going to see earnings sort of fall away? And I'm still on the fence on that one.
I think a lot of market participants actually are, aren't they? And they're trying to have it a bit both ways at the moment, because there are not clear signals one way or the other. You can, and in fact, of course, being very data dependent as central banks are at the moment, every time a new piece of data comes in, if it's above expectations, it drives them one way. If it's below expectations, it drives the other way. And that, to my mind, explains some of the dynamics we've seen over the last few weeks. But because the signals are mixed, and because the signals are actually conflicting, it's hard to make a decent call. The other side of it, of course, too, is that the Fed has been reactive, and central banks tend to be relatively reactive because they've been in data dependency mode. There's no real forward thinking. There's no strategic communication going on. Now, I'd argue that forward guidance was a mess in the first place. Think what Phil Lowe said and what happened, right? And Michelle Bullock, did a bit of forward guidance in her last press conference, even if it was slightly unintended in terms of saying, we're not going to cut rates soon. But the fact is that central banks seem to be pulling back from sort of looking forward. And again, that creates a void.
Yeah. But I think as well, let's say, we're obviously at a turning, we're close to terms. Yeah. It looks like we're at close turning points. So we're obviously at a turning point. But it looks like we're close to turning points. And that's where it can be very difficult to try and work out, how far do we extend these trends, and which are the trends that are fading off and which ones are coming on. And I think even more so in the scenario we're in now, and I guess that's what I was talking about saying, is this going to be a normal cycle or not? So a normal cycle, markets run hot, lots of debt. We see interest rates jacked up. We start seeing companies falling over. We see bankruptcies rise. Economic activity starts to slow down. All of a sudden, we start getting some price falls. There's a few people who have over leveraged. They go a bit broke as well, and we can start getting unemployment, and then we start getting interest rate cuts, and we eventually, we cycle and we go back again. Now the question on this one is, well, we put up these interest rates to rescue this inflation. It wasn't really a debt driven. We've got far too much debt. Everyone's spending all this money on everything they can, and so as interest rates are starting to fall, is that because those effects I was saying before about the supply chains are finally clicking in, and so it's not a matter of we're raising rates because we're seeing these crazy amounts of unemployment. It's they're lowering rates because they're starting to see a little bit of a tick up in unemployment and inflation come back into flow. So are we going to see a big unemployment cycle where we see a lot of people lose their jobs, and that's the factor which I don't know. It's if you took me back 2 years, I would have said yes. But I do think there's enough capex out there, and all this government spending, as you said, that's still ongoing. That's sort of holding up those levels, and that's I think where you can come up with the argument on the AI side is that there's a reasonable amount of capital expenditure out there from companies that can well afford it, and it's morphing into government spending money, and particularly militaries and a place like that, militaries and sort of security apparatus within governments that are out there trying to spend money on AI to try and work out what's happening, and they might be wasting money, and some of them probably definitely are wasting money, but that money's ending up in the hands of private companies that are then making higher profits and recycling that back into higher wages for employers. And so yes, I think it's not a typical cycle. Is I guess where I'm getting to, and I think investing to assume that it is going to be a typical cycle is a wrong move right now. I think you need to keep an eye on that part and keep watching all the indicators. But we need to be, for me, I'm investing as if we're into a cycle that's not normal. And so I do think you're right in terms of there being some weakness coming up at some point. But we'll be looking to use that to as long as it's not, as long as we don't go through some sudden crashes, we'll be looking to use that to pick up some more stocks rather than to abandon ship at that point.
Yeah, well, zing whenever we're zagging is often a good thing to be doing, as long as you know in advance what it is you want to pick up at what price, right? That's the trick, right? So you don't, rather than panicking, right? You have a strategy.
Yeah, exactly. You need to, with all these, you need to have your break glass in case of emergency, your exit plan done before the event. You're not sort of sitting there going, oh wow, the market just fell 20%. I should really, what do I do now? You'd be like, well, the market fell 20%. Now here's my list of things that I want to be doing. And that sort of fell back on that. Sorry, we're talking about the government spending. It was around the whole uncertainty around the US election as well. That's obviously sort of figures into that as well. Insofar as we spoke about, you spoke about all that debt coming on, and there's about a question saying, well, if Trump wins, there's most likely to be a lot more debt. He's likely to get out there and spend. If Kamala gets a clean sweep of the House and the Senate, then she's probably going to spend. We don't really know what she's going to do, but she's quite likely. But based on stuff, she'll be out spending lots of money. It's really a case where if Kamala wins and it's a split Senate, House, or must be Republican, could be controlling both if it's really close. Then it's likely that I guess they'll let the deficit hawks have their day in the sun and try and pull back on spending. But I think even in that sense, that stuff takes time. Like it takes a couple of years to really kick through those, and we've already got a reasonable tailwind from the last batch of spending, as you said. From we're talking about the amount that's being spent by governments. It doesn't turn on a dime. Markets do try and look forward, but if you're trying to work out, look, when's legislation going to get passed and when's it actually going to get implemented? We're talking years before that, and then you've got to wait, maybe another year before you actually get the impact of it. And so,
it's interesting. So if you look at the UK, we just had an election over here, and the Labour Party got in with 2/3 of the seats, but 1/3 of the votes, which tells you something about the way that the system works here. But they've now come out and said, well, actually, things are a lot worse than we thought. No surprise there, of course. We've got £22 billion worth of unfunded stuff. So we're going to have a very, very tight budget. And so they're now really going to an austerity mode, and they're saying, well, we're going to probably have to put tax up on all of those things, and therefore, what's interesting is that the expectation before the election was that things would get easier under the new party. And then guess what? They've now come in and found that it's a horrible mess, and they're going to have to do a lot more tightening than they thought. So that, of course, has a bit of a consequence then on markets. So markets were quite buoyant directly after the election. Business confidence dropped back a bit now because of what's happening. And as a result of that, all of those things have sort of played into continuing uncertainty. And to me, it speaks to the fact that whilst governments might have an aspiration to do things, reality sometimes gets in the way of what they want to do and need to do. And
and competence also gets in the way.
Funny that. Yeah, I was going to say. Yeah. And of course, thinking about how do I get re-elected next time? Because of course, the next election cycle then starts to play in, and all of those things then determine that you end up not where you want to, but where you actually come to. But the point I was trying to make was that there is a very strong theme of austerity now coming back into vogue in the UK. And I suspect we're going to see a little bit more of this in other places, partly because a lot of governments are now much more committed to big increases in defence expenditure for all the reasons that we're aware of. The fact that we've still got the debt overhang from the COVID period, the fact that the costs of everything has gone up. So the cost of government services have gone up because inflation has sort of fed its way through. And the fact that a lot of other stuff that they want to do, they can't do because they can't fund it. So it's get the feeling, I think, that we are going to see more pressure on the tax take, and that's a real, I think, important, significant issue. Not least because if you look back historically, profits have risen substantially, but income's not. So you've got this big disparity, and one of the reasons incomes are actually under pressure is because income tax is way higher as a proportion of what people are paying. So it's a bit of a mess.
Yeah, but I guess a question I guess I've got for you, Martin, and this is the one. Like, I mean, I don't know. I don't think anyone knows the answer for sure. But the question is, if we get a decent tick up in unemployment, say in the UK, whether all that goes out the door. And they're like, well, we saw during the financial crisis that actually we throw money at people, people are happy and the economies go well. There might be a bit of inflation, but that's somebody else's problem, or that's future me's problem.
Yep.
And I guess that's where, like, the real inflationistas out there who are like, inflation is going to be structurally higher. I guess their view is, I guess that we flipped, a switch has been flipped, and we've spent 20 years in austerity, and now everything's going to be excess. I think I'm a little bit more with you in that the bias will be towards some austerity, but a very quick finger on the trigger button if things start to get. I'd love to have austerity as long as everything's going well. As soon as there's a slight chance that my voters might take some pain, I'm ready to flip back, and that's where it'll. Well, we don't know. Nobody knows, but it'll be interesting to see.
Nobody knows. It's all down to the political gamble, right? And I have to come back because we said it earlier on. Policy mistakes from the last 20 years has created a problem in Australia. The trouble is that there isn't necessarily a motivation from politicians to do the right thing for ordinary people. They're interested in the political game, and not least because we have a lot of politicians who were career politicians. I interviewed Gerard Rennock, the senator, the other day, who's now independent because he wasn't back for a selection under the Liberals previously. And what was fascinating about that, because he's saying it's really tough if you're if you've got a different view to what the government's trying to do, it's really tough to sort of get any airtime because, of course, they've got their own agenda, which is about getting re-elected, and they'll do anything. They'll sell their grandmother if it's the right thing to do. So the politics is absolutely in the middle of all this.
Yeah, and I'd argue as well from the UK perspective, the best thing you could have is the expectation that I'm going to be, of austerity and I'm being responsible and all that type of stuff. But from an economic point of view, no, I'm actually just out spending the money, and so everyone feels good because your wages are going up and you're still getting lots of services. And
it's words and figures differ, as I said on the old banking check. Now, I've got a question from Phoenix here. We might just put it out because it's actually quite a good question, which is simply, how do bonds work? Do you have to wait 30 years or can you cash out any time? So I'll let you run off with that because basically, no, you don't have to wait 30 years.
No, that's right. I think the best way to think about this is, I think this works for people. You think about it like a term deposit you can sell. So you can effectively get a term deposit that's going to last you for the next 30 years. And in 2 years' time, say interest rates have fallen and you've locked in, you're 4.5% for that. In 2 years' time, interest rates have fallen back to 2%. and everyone's going, "Hey, what a great job you did on locking in 4% for 30 years, and now I'm facing 2%." And I tell you what, how about I buy that decision off you? I'll buy that term deposit off you, and it cost you $100 to get in. I'll buy it off you for $110, or I'll buy it off you for $115, or whatever it is. And so that's effectively a bond. And the flip side, though, is if interest rates go up, then and you're trying to sell it, is that interest rates go up to 10%, and all of a sudden you're saying, "Hey, I've locked in 4.5% return for the next 30 years," and people are saying, "Well, that was a stupid decision. I'll give you $60 for your $100 worth of face value at the end." So yeah, so that's and so what we tend to do is on the active portfolios, we'll tend to take a bit of we're often, when we're worried about things falling over, we'll take a bet at the longer end. If we're thinking interest rates coming down, we'll take a bet at the longer end to help, because it's a bit of an option in terms of saying when stock markets fall, often bond prices rise. They're not enough to offset your stocks usually. So you might see, let's say you went through a big downturn and the stocks fell by 20%. Maybe your bonds might have risen by 6% or something like that. And so, but the thing is, I get to sell those increased value of my bonds and go buy cheap equities with it, because it's sort of like it's a bit of a free option in terms of those. So that's sort of the active part of it. There's also a passive part that we run where it's basically just a bond ladder, we call it. So all we're effectively doing is just buying 15 years worth of bonds, and you've got one every 18 months or something expiring, and when one of them expires, you just stick it out on the end, and that's sort of like your longer term sort of locked in that income for you. And then we do have some strategies we run for people every now and again, which is like just saying, well, let's just you really wanted to get interest rates and you want to lock them away for the next 10 years or the next 20 years. Okay, let's just get you something that'll do that, and run that out to maturity.
Yeah, and just to be clear, there's a difference between the coupon on the bond, which is what you get paid every year, and the face value of the bond, which is always 100 or whatever it is, right? But the price of the bond when you buy it goes up and down based on the calculation of the forward calculations on those future payments relative to interest rates. So the bond price and interest rates go in opposite directions.
Yes. And the other interesting one is inflation-linked bonds, which are even more confusing, but they do help if you're worried about inflation. And so what effectively they do is they'll pay you, I don't know, like say a 1 or 2% yield on it at the moment, but that yield will go up at the value of inflation, and your capital will go up at the value of inflation. So lots of complexities behind it, but basically you stick $100 in, and let's say you're going to hold that for the next, so it might be a bond that's expiring in 10 years' time. So I put $100 into this bond. If I bought a normal bond, I'm getting $100 back at the end of it. This one I'm not. I'm going to get back $100 plus whatever inflation. So if inflation runs at 2.5%, I might get an extra $30, some compounding and stuff like that by the end of it. So buy that bond to get that, and I'll only get like a smaller yield. It might be 1 or 2% yield, but that will be also going up at the value of inflation every year. So that will be increasing. So they're a great asset at the right time, those ones, and it's good to have some of them in your portfolio. But there's one of those ones where we'll try and I'm always watching it, because if the spread blows out far enough, and you're like, great, I can lock in returns for the next 10 years of that plus inflation and a decent yield, done. I'll take that as not as a whole of your portfolio, but certainly as a small part.
Of course, the caveat here is not all bond holders, bond issuers, I should say, are actually of equal risk, right? So there's a difference between bonds issued by countries, which in theory are the least risky, particularly the US. So US treasuries tend to be a benchmark, but different companies and different entities can issue bonds with a different risk, and that has a different premium. So don't necessarily assume that just because that coupon sounds really good, you've got to also do the work on thinking about the risk that's actually attached to it.
Yes,
because you can.
I'm talking about government bonds, Aussie government bonds. Yeah. So and a lot of Aussie companies in particular have floating rate bonds.
Yes.
And so you're not locking your interest rate in. You're just getting it's a bank account with it's not a bank account officially, but it's like a bank account, but it's paying a higher rate of interest because you're taking more risk. Is the for a lot of those. So yeah. that definitely makes a big difference. And the other one I'd say for people who worry about, say, the Australian government, will they pay me back? I'd look. The odds are very low that they're not. But more importantly for Aussie investors is if they default on the bonds, it's not going to be Australian investors who they're going to default on first. It'll be international investors. So you vote in Australia. They're not going to say they've got 200 billion and they have to default on 20 billion or 30 billion dollars worth because they can't pay it. They're going to pick foreign investors, and they'll default on those tranches. And then, if they get to the stage where they're defaulting on Australian bondholders, well, having your money in the bank probably not going to save you.
A few bigger problems. Yeah. And of course, the fact is that there's more money from Australian government issued overseas than in Australia because of the fact that the markets are way bigger out there. So, and there are a lot of international investors who quite like Australian bonds because they sometimes pay back a little more. Now, it's interesting because there was a little question that popped up, which was, I'll just put it up on the screen there. Leo said, where does the average person buy bonds? And that's quite an interesting question because
the World Fund.
It depends.
Yeah, that's right. Okay, no, but it's an important point is there are some listed ones which you can do. And that's probably the easiest way. The spreads on that can be a bit wider. You need to be trading those a bit more carefully. There's a lot of bonds are over the counter, so they're not traded on a market, and even the ones that are traded on the ASX are actually a sort of look through onto some of the private markets. And within those private markets, often they need really large amounts. So you might be talking hundreds of thousands to invest in some of those lines, or getting brokers that will slice it all up. Whereas on the stock market, or if you're buying through somebody like a Nucleus, you can just invest whatever, a couple $100 and sort of put them through as.
And of course, there are also ETFs, but just bear in mind that the ETFs attached to the bonds have fees nicely clipped all the way through, don't they?
Yeah, and the other thing, there's some interesting ones with bond funds and ETFs as well, where you didn't actually get the yield over the last few years. Like the yield's been wildly different to the actual underlying bond yields.
Yeah.
And I don't know, I'm probably getting too far into the weeds on this one, but basically what was happening is it made more sense for the companies to keep the money, keep the interest they were paying, and because there were tax implications of what they were doing, and because they are buying and selling relatively constantly. So that's one of the benefits. Well, from my perspective, anyways, when you put money into a bond ladder, you take $100 and we buy 10, say we stick $10 in each, and now you're not buying or selling those; they're just sitting there, and you're just collecting the dividend. If you go and stick that $100 into an ETF, or you go and stick that $100 into a bond fund of some sort, they're likely trading around a little bit in some of those, and it might just be people buying in and selling out. You've bought in, and then Martin buys in as well, and then Martin decides to sell out again, and so the bond funds turned over some money to pay to buy Martins and then sell back out again. But that's probably created some tax issues, and they might be doing different things with those tax issues. And so, and then the bond fund itself is trying to maintain the right durations, and they're sort of sitting there trading. And so, you can sometimes end up with, overall your returns are probably not just that dissimilar to having bought the bonds yourself. But if you're buying it because you want a yield, and then all of a sudden you're not getting a yield on this thing, and you have to actually go out and sell the stock in order to get the money, that sort of can be disturbing for people.
That's a good point. And of course, if in fact there's a little bit of a run, and so a number of investors say, sell now, sell now, sell now, those funds actually will prioritize the things that they can sell relatively quickly. And sometimes that means that the price that they can sell them at isn't necessarily what you'd hope they would be. And it means that the value of the rest of the fund that everybody else has got actually gets hit because of it.
And that's where the other benefit of buying the government bonds, like they're the most traded instruments in the world. When you buy an Australian, say, 10-year government bond, and the proverbial hits the fan and stock markets are falling and all that type of stuff, that thing is still trading, and it's probably going higher. It's not. That's a that's an asset you can sort of take back. If you've bought, some small cap corporate debt, funding that you managed to get a 9% yield on, the thing's just not trading. Like, yes, I want to get my money back, but all of a sudden you're going to sell it to somebody at, on a 15% yield, or, you got to take massive falls in your capital if you want to get out in that time of distress. And that's why we tend not to include corporate bonds as part of our sort of core assets for people, with a view that look, they're interesting, you make returns on it, but often what you find is for me, I want bonds when the market's crapping itself, and we've got these big falls, as you said, 30, 40, 50% falls, and they're the times when government bonds will support you, but corporate bonds will tend to be, the spreads are blowing out, and other things are going on. And you just can't get the same duration as well. Like, often the company loans will be 5 years rather than 10 years or 20 years you can get from government.
But it is worth just sort of bringing the bond conversation to a close. There are times when, in fact, the bond story is worth exploring, particularly bearing in mind this inverse relationship. If interest rates do come down, bond prices tend to go up. If you're holding bonds, therefore, not only do you get a coupon, but you potentially have value being added to the bond if you trade it out. Of course, if you hold it to the end, you still get what you had originally, unless you have inflation bonds, that sort of stuff. So got to understand that mechanism. Now, let me just, before we close off, I want to just come back to NVIDIA and AI, because I think that's another very important conversation point. Here's the NVIDIA chart, and you can see there that NVIDIA has, wobbled up, peaked. This is after the split, 140, give or take. It's now sitting 119. It dropped significantly. But for me, the most interesting aspect of this, Damien, was the most recent results. Because if you actually read the results, there were three things that I noticed. The first was they've got a problem with the next generation chip. It's taking quite a lot longer than they expected, and that's going to have an impact. Secondly, the suppliers to NVIDIA, the people who are actually making the chips that actually go into the to the AI machinery, are starting to actually want to increase their profit and therefore put the price up to NVIDIA. And NVIDIA, of course, is now in the situation where there are some other players now starting to have the AI story take. So they're actually experiencing some potential margin compression. Third, they're still projecting a significant rise in terms of revenue growth and momentum. Less certain, I think, on profitability, but momentum still strong. So how do you make sense of all this? And bearing in mind our earlier conversation that we think that AI is not just the chip companies, but actually it's the implementation of AI more broadly in the data centers and the other players. And, there were some other players who did quite well, like Dell, for example, because they're selling a lot of servers at the moment with the AI inside.
Yeah, so I think that the key for NVIDIA is working out whether they are a part, albeit a very important part of a server that is going to do the AI calculations, or are they actually transforming the way data centers work? And what I mean by that is NVIDIA's sort of got a number of different parts to it. So one part of it is they've got these GPUs that are very efficient, and they've been doing those for years. And so they're graphics processor units that are basically do the calculations they do for showing a computer game actually happens to be really efficient at doing the artificial intelligence calculations. The other thing they've built, though, is a bit of an ecosystem around this. So they've got these GPUs, they've integrated them with memory that is on there. So that was sort of one of the bottlenecks, was GPUs into it. And so they've got effectively stacking the memory and integrating that tightly into it, which is, they're not the only one doing that, but they're very efficient at that. And so that's really useful. Then what they're talking about is, and then they've got other systems that let GPUs talk to other GPUs. Now, the reason why this is so important is because the old data center model was effectively, I set up this data center, I stick a bunch of racks and cooling and all that type of stuff and a bunch of servers, and the servers all sort of work pretty much independent of each other. Somebody's watching a YouTube video on one, somebody's downloading a PDF off another one, or surfing the internet, and they're all sort of independent about what they're doing. Now, the AI model is effectively, we need to take a massive data in and run calculations on it. So the more we can hold in memory and the more we can do locally and talking between these machines, the better. And that's what NVIDIA's sort of built up this whole ecosystem and this whole process around is not only how do we get the best GPU out there, but how do we integrate it with the memory and so it can hold more and do these larger data sets? And then how do we make the GPUs all talk to each other really efficiently so that within a data center, so that the unit of compute stops being a chip on a computer and actually starts being the whole data center. How is it working to do these calculations? Now, if that is what NVIDIA is doing, is becoming this new data center, the whole infrastructure behind and the whole process behind, and it's going to follow their vision of how these things are going to work, then there's more value and there's a reason to be buying it at the current price. If they are just a good GPU maker and happen to have a market leader in the way it works, then they're expensive, and yeah, you should be selling if that's all you're doing. And mainly because it's just a nasty industry, this whole chips. Like the leader of 3 or 4 years ago can be nothing, in a few years' time, because they've picked the wrong technology, or they got the wrong, whatever it is, and nobody cares. If you've got the fastest chip, and I'll take it. If you haven't, then you're out. There's no sort of, I've been buying Intel for 20 years, don't care. I've been buying IBM, you can't, IBM was the leader for ages, and you go through, market sector by market sector. And then they've all got to get out and spend that money. There's just masses they're spending on R&D. So yeah, nasty sector, nasty industry. But are these guys? They're still not going to get the most of the AI. Like, they still got, as we spoke about before, the AI is about companies actually using it and all that type of stuff. But they do have this part right now where there is a question mark on it. And now the question and the issue we've got is, people are looking at these lines going up on a graph and saying, hey, they grew this by 20%, and then they grew it by 25%, or, they doubled it. Actually, sorry, probably more the other way around. They doubled it in 3 months, and then they doubled it again in 6 months, but they're slowing down, so the rate of growth. And so if I extrapolate that line out, and I've got this line, where does that go over the next whatever period? And that's why we're seeing these wild swings around in the price. So second quarter earnings were really good. Beat forecasts, well above and all that sort of stuff. Third quarter, they've got this hole. Then this new chip, which is streets ahead of everyone else, has had some delays. Having said that, it's a bit hard to sort of, NVIDIA is not the manufacturer of these. The manufacturer is TSMC largely. NVIDIA is heavily involved. So, is this a sign? And so I guess there's people reading into saying, okay, is this a sign that NVIDIA can't handle the growth? They just haven't got the processes and the systems. And so, is this a sign that, those rosy growth forecasts you've got going out in the future just aren't going to be met because they just can't, they're growing too big. Now, I don't think so. That's to me, it's a TSMC problem as in a large part. But the other part is, they've actually, doubled their. They've been double. The first one, they're doubling it every 3 months, and then they're doubling every 6 months. Like, they've got these massive increases they've actually managed to get through. And right now, the issue tends to be, oh no, I can't get this this new NVIDIA chip. So maybe I'll wait 3 months to get it. But if I need to get something and I'm buying it today, I'm buying the old NVIDIA chip because that's still the best out there. There's not like there's another one there. So we do have a whole bunch of people trying to work on competitors, but none of them are anywhere close. So it's this real extrapolation you're taking from very small pieces of data and trying to work out what's going to happen. So third quarter is definitely going to be weak. That's the next. So they've just reported their second quarter. Third quarter is coming up. And again, just to confuse you, they actually report to the January 2025. So this is third quarter 2025 numbers we're talking about, which, anyway. So it's weird in terms of the numbers you're talking about. So I would say more volatility over the next 3 to 6 months, and this Blackwell chip, the success of that is going to make a big difference as to whether we see another leg up or leg down. Um, so what are we talking about in terms of numbers? So 2024, which is sort of was 2023, in a real sense. So they did $32 billion worth of profit on $61 billion worth of sales. So the next year we're talking about they're forecasting to do $70 billion worth of profit on $121 billion worth of sales. So that's the over the next the year ending in the next 6 months. So then you go 1 year out, we're talking about 95 billion, and next year out after that 108, and that puts you on 27 times the earnings. And we spoke about the market being on sort of 21 times, 22 times. So you're paying 20% more than the market for some pretty good growth. It looks like if you look at so there's two ways to do this. One is you ask companies. One is you look at NVIDIA and try to work out what NVIDIA is going to make. The other one is you look at Apple's and Google's and AWS and those, and you ask them how much you're going to spend on AI chips and CapEx. And if you look at their CapEx expectations, NVIDIA is becoming, and you assume the NVIDIA numbers are right, the forecasts, then NVIDIA is losing market share to somebody. We don't know who. So it's not like you've got these NVIDIA numbers that are wildly optimistic relative to what their customers are saying. It looks like from NVIDIA's numbers, if they kept the same market share, then these numbers are going to be too low. But then you go back to that whole margin issue, and are you going to get margins? My take is that maybe there might be a little bit of margin pressure, but I do think NVIDIA's got the whip hand in terms of they're the ones that people want to buy. Like if it's got whatever components going into that, they're in some way important, but they're a lot more replaceable in terms of I can replace that part, your part with your competitors' part, so you can't bid up the price too much. But when it comes to somebody buying these servers, they're paying for NVIDIA, and talking to people and listening to people who are doing the buying, there's just no this is no competitors at the moment. Like sometimes you can look at markets and you can sort of say, oh, look, whatever videos, everyone's selling more VHSs, but Beta is a better technology, and all this type of stuff like that. And you should be buying Beta, but everyone else is buying VHS. There's sometimes you got arguments for that, or whether Unix and Windows or Apple and Windows or whatever it is, arguments about what things are better or not. There's very I don't know if there's zero argument, but there's very low argument about is there a competitor out there that's giving you a better chip than NVIDIA? And so even if you did want if you want to be very contrarian and you were working at one of these places and you wanted to buy it, it's just very hard to find a competitor. But plenty of people working on it as well. We spoke about all the biggest guys are Amazon, Google. They're all working on their own chips, but just nobody that's close at the moment. So yes. So I would say the next 6 months will be pretty volatile on the share price, and it's either your big factors. Are they the part of the data center going forward, and does this Blackwell come off in a reasonable, without too many hiccups? I mean, a 3-month delay in a delivery of a chip where is nothing in terms of the history of these things, and it's not even a 3-month. I think it's less than a 3-month delay. So, if that comes through as expected, as the company's saying, then that's you'll have forgotten about it. But the flip side is maybe this is just like a small sign that the problems are starting.
Yeah. And ultimately the question is this a replay of Cisco? I showed on the previous show, I think, that we did, Cisco diving subsequent. Intel, of course, is significantly down because they're now seen as a very slow up on this and, trying to find a way forward. But on the other hand, at the moment, the story around around NVIDIA still seems quite interesting because, as you say, they've got some uniques. But is it interesting also that there are some people now suggesting that maybe they should look beyond the high-tech sector? And, of course, the equal weights, this is actually the S&P 500 equal weights, has reached an all-time high. And that's fascinating. What it suggests is that actually people are beginning to spread their bets a little bit in terms of where to go next, whereas previously it was the AI story or bust. So there's some interesting rebalancing, and there's again massive polarization amongst the analysts on this. There are some absolutely wedded to the AI revolution and talking about the next industrial revolution, and that these numbers are way under where it could go. There are others saying, well, maybe it's peaks and maybe it's time to sort of switch and actually spread the risks and look at some of the other sectors that have underperformed less, but potentially could do better in the low interest rate environment. And again, that shows you the dilemma that we face at the moment.
Yeah. Well, look, I tend to, within our portfolios, we sort of run this quality value mix where the idea is very much that if I can find a high quality stock and buy it, even if it's a bit expensive, that's fine. I buy it and hold on to it until it gets like really expensive, then I'll tip it out. Or if I'm buying an average quality stock, I want it to be really cheap. And you know what? If it starts getting anywhere near average value, okay, it's time to tip it out and go find another. Sort of average quality stock that's cheap. And so there's always this interplay between value and quality. What am I getting for what I'm paying for? And so the question with NVIDIA comes back to, am I getting one of the highest quality stocks in the market? At the moment, absolutely, based on its earnings. The question then is saying, how much do I discount? So based on its earnings, then how much do I discount for the whole nature of the sector and all that type of stuff? And so you bring it back, okay, so not as high quality for all these reasons. And now how much do I pay for it? So on 2-year forward earnings, if I'm paying 30% more than the average stock on the market, it sounds like not a bad bet. But it is very much this extrapolation of movements now, years into the future, which is why you're going to see all this volatility. What was the other one I was going to say on NVIDIA? It was so for me it's we haven't got heaps of it. Oh, sorry. Overall, as a portfolio, it's big because it's just a big part of the market. But we're not sort of all in on the bet, but we're enough in to say, look, if they get it right, and there's enough signs that sort of say that they might, that we don't want to be not owning it in that case. So there's that. There's some other big themes we try and sort of hit is the weight loss drugs and both on the positive and the negative side, which are the companies getting who are going to lose out from that. There's a number of ones in terms of climate change. I've actually got very few. I actually think the companies investing in the climate change technologies tend to be expensive and bid up to prices that just aren't worth it. But there's definitely stuff you can avoid in terms of companies that are involved in technologies that are sort of losing out on that front. Some of the other big themes. So a lot of it for me is about saying, okay, where am I hunting? Well, I'm hunting certainly within companies, I think, high quality at the moment. So we've been through this burst of inflation. We're starting to see the deflation coming through. The key thing I'm looking for in companies is who can actually hold on to the margins that they got. So if you've just jacked your prices by 30% in the last, 3 or 4 years, can you hold on to that? Or are you like a car manufacturer who, yes, you've jacked your prices, but now you're facing all this competition and everyone's starting to put on more and prices are now into deflation. So where are you sitting in terms of that model is for me the key part when you're looking outside. And I do think that equal weight one, that is a sign of what I was talking about, those earnings numbers. We're finally seeing some earnings growth come through. And that's then flowing out to that broader market because we are seeing that market. We're seeing those earnings now. Can they hold on to it? That's obviously another question. It's sort of, and that's that push pull we're talking about. This isn't a normal cycle. If this was a normal cycle, we'd be talking about how great profits have been for the last 2 or 3 years. We're in this massive boom, and there's all this debt out there, and companies going to start going bust, and all that sort of stuff. Whereas now we're like, it's not a normal cycle. So got to be a lot more agile, I think, than price cycles, and just have less confidence that you're right about whatever it is you've decided to pick.
It's always the first question. What if I'm not right? What do I do? And, look at the other option rather than being wedded to one particular view of the future. Because, what we've tried to, I think, highlight tonight, Damien, is there's a level of uncertainty that we're seeing in the markets at the moment. Expect more volatility, expect uncertainty. The AI story is there, but it's not the only story now. We've got some political events. We've got some geo events as well that are actually there, the Middle East and others too. So uncomfortable time. September, October tends to be an uncomfortable time generally in the markets. It seems to be when things go wrong, they go wrong then. It's worth bearing that in mind. But as we come to the end of the show, let me just underscore, Damien, that through What the World Funds and through Nucleus Wealth, there are a range of tools that you have there, and those tools provide the platform for people to be agile.
Absolutely, yeah. And so you can jump on the Walk the World Fund, book in if you want to have a chat about some of these with someone from here. So somebody from the investment side, or if you just want help setting up accounts. We'd love to hear from you and to, so that if you're looking to lock in on some of those bonds, or you're looking to at least have some equities. And the other thing as well, we spoke about having that forward plan. For some parts, it's about saying, well, we saw with the Japan fall. You had to trade that Japan intraday to actually take advantage of any of those low prices. Like, it's one of those markets are moving quickly. If you're sort of going, oh yeah, I'll wake up one day and I'll suddenly feel all the stars have aligned and today's the day I'll buy, it ain't going to happen. But you need to sort of make that plan, set up your accounts, have things ready to go, so that when it is, it's you can take advantage of these market movements that we're going to get, the volatility we'll see.
And of course, the whole point about the platform there is that it's really transparent, and you can have different permutations, whether you want to manage it more yourself or get somebody else to manage it, whether you want to tilt your portfolios one way or the other. So there is a lot of flexibility. One of the reasons why I've connected with Damien and the Nucleus crew, because to be honest, there aren't many alternatives that actually give you the same flexibility and agility that they do. I want to say thank you very much indeed, Damien. As always, looking forward, of course, to doing the same in a month's time. We do this on a regular basis to sort of update people as to what's going on. Last time we said it then, we'll say it again. Who knows what next time will bring, but it will be an interesting conversation nevertheless.
Yes, well, and we're we're 2 meetings away from the next US election. So that's obviously the big event in everyone's calendars. But yes.
Terrific. Well, thank you very much. Appreciate that. I'm going to take you offline and close the show, and we'll look forward to picking up again next month. Thank you, Damien.
Thanks.
Take care. There we go. I hope you enjoyed that. Very interesting conversation with Damien, and a lot to cover there. If you want to replay it, it'll be available post the show. Just to tell you that next week, I'm going to do a show specifically on the latest household financial stress and modeling, because it's been a couple of months since I've done that live. So we're going to do that. And the following week, Tanya LaCantra is coming on, and I've got a couple of other guests teed up too. So it'll always be interesting. Plenty going on the live shows every Tuesday. Of course, check out the recorded shows on other days. We put up shows every day. Here are the dogs. They've hardly moved at all. So I think they're ready for the next walk. So Luna's saying, that's Meteor. Actually, Meteor's saying, I would like a walk, please. So that's going to be the next little trick for me. Thank you very much indeed for spending some time with us this evening. Thank you for the super chats for those who contributed. And as always, look forward to seeing you on the next show. This is Martin North from Digital Finance Analytics, signing off. Cheerio.